Jim, Adam Parker over at Morgan Stanley had a note out earlier today saying the drop in U.S. stocks is a temporary pullback and he's buying the oversold names on dips. What do you think about that strategy?
Well, I agree that this is probably not going to be a full-fledged bear market, but I think it's not over yet, and I think my guess is it's going to challenge us a little further yet, maybe go a little lower. I think the primary catalyst to this pullback is really not about China or oil prices, commodity prices. I think it was just the end result of a very vulnerable market that had built up vulnerabilities over the last few years. It became very highly valued, 19 times trailing earnings at the top. For the first time in this recovery, investors had become calm and complacent to some extent about the future. This country faces an inflection point where it's going into a period of full employment in the economy, a need to reset interest rates higher, probably coupled with, margin erosion and wage and price pressures to some extent. And I think that the stock market needs to get to a different level to form a better foundation to handle an economy that's going to have a different character going forward than it's had up till now. And I don't know if we're there yet. I think if we just go right back up, I don't think we did much. If we stay down here, re-challenge the lows, maybe even break a little lower, I think we'll truly cleanse sentiment and we'll get to a valuation level that I think is much more sustainable for another run.
Yeah, it's funny.
So I think we might.
I was going to say, Jim, it's sort of what I hear in the oil community as well. Mike, you need to go lower before you can be healthy in order to go higher. And if you take a look at some of the stocks that really saw a lot of steam sucked out of them today, you look at those momentum names like a Netflix, for example, breaching its 50-day moving average, bouncing around those moving averages there. What do you hear?
Well, there were so many spasms in the market that possibly could have had nothing to do with fundamentals. Obviously on Monday, there were a lot of issues with the actual pricing and the net asset value calculations of ETFs that some people are pointing to that as sort of exacerbating the volatility. Also, a lot of volatility halts, stocks stopped trading because they were moving so fast. So some people are pointing the finger at that, saying that caused it. And really just a lot of speculation about what is happening inside of these black box strategies. A lot of strategies that just go off, are based on momentum or based on things that don't have anything to do with equity fundamentals. And Jim, I'm wondering if you have any thoughts on this. Does that kind of spasm that really has nothing to do with fundamentals like we saw this week, does that cause its own damage to the market as far as sentiment and people's willingness to buy the dip?
It could. It certainly could, Michael. I think it did earlier. I mean, look at the flash crash, that we had a few years back. I think that created a lot of psychological damage. One thing I'd say, I think we've got a culture that's developed out of the '08 crisis and the subsequent massive, sharp sell-offs that were, each one of them was supposed to end the world, and none of them did. And as a result, so many investors cashed out every time and got left out when it ran higher, that this time they're like, oh, I know what this is about. We get a crash, I buy, because I know it's going to go back up. And I think that might be to our detriment to some extent, that we've come that far. On Monday and Tuesday, when it was really crashing, there was certainly volatility and an escalation of VIX, but you didn't see the outright panic of people rushing to the safe haven treasury. Yields are higher today than they were when the market was above 2,100. You don't see a rush to the U.S. dollar. It's still down from where it was when this started. And you don't see a rush to gold. Traditionally, the assets that people move to when they're really panicked. And I also think most opinions are like mine. This is just a temporary refreshing pause, a buy opportunity. I think when we're done, there'll be more panic, more fear that it's a bear market, less people saying it's a good buying opportunity.